Welcome, everyone, to Team Wealth Live with Matt Sorensen. Excited to be with you here today. Today's topic, we're going to be talking about rental real estate, tax benefits, fact and fiction. I want to set the record straight on the benefits of rental real estate investing. I think it's freaking awesome. We're going to talk about it. I do it myself. We recommend real estate investing for a lot of our clients as a way to diversify their wealth, and also because there are some great little tax perks for real estate investors. However, those tax perks are overhyped. There's so many people who overhype the benefits of rental real estate and talk about benefits that some people get in real estate investing, but most people don't. So I want to bust that myth today too. But let's go over the benefits of it so you can put in focus what the benefits are to owning rental real estate. How do I save taxes as an investor? I got a day job, whether I own my own business or I'm employed with an employer and I own rental real estate. How does that income or loss from that rental property help me? Why is that beneficial to me on my tax return? How does that help me build wealth? So I want to break that down in today's live. Today, we'll, of course, take any questions on that topic. For any of you holding on here that are like, I had some questions about something else, don't worry. I got a lot of questions that came in already, a lot from YouTube, people that asked Matt, which, by the way, you can go to mattsorensen.com, hit the Ask Matt. I'm going to hit those questions. Any of you that posted in the Team Wealth Building Facebook group or through that channel, I have some of those questions. So we're going to hit other questions that have already been posted here in a bit. But as we're going through this first section here, and for today's show, just know we're going to hit the topic of choice here that I have, which is rental real estate, tax benefits, fact and fiction. All right. Let me say the first benefit to buying real estate, and particularly rental properties, is there's an ability to get cash flow from the rental property that you get to put in your pocket every month, and you don't pay taxes on it. Let me repeat that. The primary benefit of rental real estate for everyone, this is a benefit everyone can get, is you can be cash flowing on the property. Money is in your bank account. You're expending expenses on the property. You've got rental income. The net of that is cash flow in your bank account, but you don't pay taxes on it. And I'm going to explain why. It's because of depreciation, but we're going to break it down and get super specific on it, because a lot of people hear that, but they don't really know what it means. And then they hear other people talk about it, like Grant Cardone or other large investors, about how they pay zero taxes and all the rental real estate writes off all their income. Well, I'm going to talk about why that works for them, but it probably doesn't work for you. It doesn't work for me. Okay. So I want to be intentional about that and make sure everyone understands how this works. Okay. Let's just do an example here, okay? Let's say you bought a property, and let's show the whiteboard here for a second. Let's say you bought a property for $300,000. You rent it for $2,500 a month. And let's say you have, so obviously through the month, you had $30,000 of rental income. All right. Now, I've got $30,000 of rental income. Well, I also have expenses on the property, right? All right. I have a mortgage that I got when I purchased the property. My mortgage interest, by the way, when you have a mortgage, your mortgage payment consists of principal and interest. The principal you don't get to expense. Now, this benefits you because the principal is paying down the loan, right? Giving you equity in the properties, you're paying down the mortgage, the principal part of it. But you don't get to expense that, all right? Now, the nice thing about that, we still love that mortgage pay down. The nice thing about the mortgage pay down is your tenant's paying your mortgage, right? So they're paying it down for you. But generally, particularly with most mortgages, you're going to have a lot of interest upfront in particular. So in this example here, I took let's say I assumed you put 20% down on the property, got a mortgage at 7% interest. This is the mortgage interest you'd have through the years, $16,838 of mortgage interest. You have $3,000 in property taxes, $1,000 in homeowners insurance, landlord insurance, $2,600 in property management, and $2,000 in maintenance, okay? So at the end of the day, you had $25,000 of expenses approximately, okay? So you really made $5,000, right? I mean, you had some mortgage pay down, you have some cash flow in your bank account. You actually made $5,000. Do I pay taxes on that? I mean, I tracked everything on my, then there's a lot of other stuff you could have written off here, by the way. We might want to get a little more expenses here, take some home office, some travel, there's lots of things we could add into this. I'm just hang with me here. I'm trying to keep this simple. On paper here, and in fact, you made $5,000, but does that go on your 1040 as $5,000? No, we have one expense that is not in your QuickBooks. It's not in your bank statements. It's not going to be on any form anyone sends you from your bank or property management company about this expense. And that expense is depreciation. This is the number one expense that real estate investors who do their own taxes miss. They miss this expense because they don't know how to do it. Depreciation is typically the second largest, sometimes it's the first largest expense. The only expense you typically have larger than depreciation is the mortgage interest. So you've got to understand how to use the depreciation expense. This is what's going to benefit you. And by the way, spoiler alert, this is what's going to wipe out that $5,000 of taxable income here and actually give you a loss. And by the way, we might use that loss in other places on your tax return. Okay, let's talk about how depreciation works here. Okay, let's hang with me on the slides here. Okay, let's say you had the same property here. You bought for $300K. Now, when you depreciate a rental property, the IRS makes you look at that rental property and say, all right, what percentage of that is land and what percentage of that is the building? Because we let you depreciate the value of the building over time. You can't depreciate the land. What depreciation is just this concept in the tax code that says when you buy something, it doesn't last forever. So we're not going to let you expense the whole purchase price. The building here, let's say of $240,000, if I allocate that much to the building, we're not going to let you expense $240K immediately. But for a residential rental, we'll let you write it off over 27 and a half years. We presume the life of a residential rental property is 27 and a half years. So at the end of 27 and a half years, you're going to have to rebuild it or start over. Now, we know that's really not the case. Just saying that's how the tax code works. So I get to divide that 240K by 27 and a half years. Okay. Now, I'm just doing the very basics here on how this works. That means I get a depreciation expense of $8,727. Okay. I get a write-off, $8,727. I didn't spend 240 grand to buy this property. You know, maybe I put 20% down or 10% down, or I bought it with creative finance and I put nothing down. I mean, it doesn't matter what you spent. The building itself, whether there's a loan on it or debt on it or subject to, or you put some cash down with the loan, doesn't matter. You still get to depreciate the full value of the building. Now, 80-20, whenever for any property is kind of a reasonable way to do it. You can get a little more specific on that. But if I have a rental for $300K, I'm at least going to take $240K of that value and allocate it to the building itself. All right. So now I've got a depreciation expense here of $8,727. Well, let's go back here to my rental income minus my expenses. I had about $5,000 of taxable income, but I get to minus out the depreciation. So now I really have a loss of $3,727. I don't have to add $5,000 into my taxable income on my tax return. I actually get to include a loss of $3,727. That is huge. And this is why I can have cash flow on a property, be building wealth because I'm paying down the mortgage as well. I'm getting appreciation of the property over time, but I don't have to pay any tax as I'm earning that income and receiving that money that's paying down the mortgage, that's paying the rent, and actually putting some cash flow in my pocket because of the depreciation expense. Okay. So that is a huge benefit to owning property in your personal name, or when you're having to go on your 1040, of course. If you own property in your IRA or 401k, it doesn't even go on your 1040. So there's no taxable income anyways. There's nothing to depreciate. Who cares? Because I don't pay tax on the income at all. But on your personal tax return, you pay tax on income you have, whether it's rental income or income from a job or a business, it doesn't matter. So we want to make sure we know how to use every deduction possible. For rental properties, the number one thing people screw up, and I just want to make sure everyone understands this, is this expense. You need to make sure this is on your tax return. You're required to take this, actually. It's like use it or lose it. So you've got to take this depreciation expense. All right, so now I have that $3,727 loss. Well, how can I use it? All right, well, let's go look at Schedule E. All right, I'm going to show you just, this is the actual form you will use on your 1040, on your personal return to put your rental properties. Now, you can see here, you can list up to 3 properties. No, can't write on this. All right. We can list up to 3 properties on your 10. expenses and things you can do. Don't forget to pay your lawyer, by the way. You need expenses to KQS lawyers here. We love that. And then of course you're going to total it out. So let's say that I had a property, and I've had this on my return multiple years, where I have a property that even after depreciation, I'm still cash flowing. It's a really strong rental property, great rental income. Even after I take depreciation, I'm still cash flowing this. So I have a positive on property A. But property B, I have a larger loss like I had here, where I have that extra $3,000 income on property A. So I can net the income and loss between the different rental properties on my 1040. Everyone gets the ability to do that. That's another perk, because as you're building a real estate portfolio, sometimes you're going to have properties that cash flow over depreciation expense. Sometimes you have properties that cash flow under depreciation expense, or sometimes you have a property that has a tenant out for 3 months, or you have an unexpected repair. You have a $10,000 bill for the AC unit. And so it jacks up that property for the year. So you actually end up having a loss. Well, that loss can be used to offset income on another 1040. Okay. All right. Now, what happens though if I only have a loss here on my 1040 and I want to, let's unshare the screen. I don't know if you're still sharing. Okay, good. All right. So what happens though if I have a loss and I don't have other rental properties to use it against? Can I offset my W-2? Can I offset my business income on my 1040 that's hitting my personal return? I've still got other taxable income. I'd love to use that loss to offset it. Well, it depends, okay? And there's going to be 3 categories here of what it depends, how it works, okay? You have either passive, we have active, making under 150K, and then we have real estate professionals. Okay, everybody is at least passive, okay? By default, you're at least going to fall into passive, which means, like I said earlier, on that Schedule E, if I have a loss on one property, I can use it to offset the passive rental gains of another property, all right? So I can still use that loss. And by the way, if I don't have a loss to use that year, I can carry it forward to the next year. So if let's say that $3,700 loss, if I only have one rental that year, I don't have other rentals to use that have a gain to use it against, I can carry it forward to the next year. And eventually I'll use it, or maybe when I sell the property, I'll at least use it then. So those losses do come into play. So make sure you're still tracking it, recording on your tax return. Even though it's not helping you in that year, it will come to benefit you in future years. Okay, the next category is active real estate investors under 150K. This is only for people, this is married filing joint, under 150K. You can take up to $25,000 of your losses and offset your ordinary income. Now, you have to be under 150K, but for any of you that are married filing joint in your return, you can take up to $25,000 of your real estate losses as long as you are actively involved. And this means you're participating in decision making, you're involved. You can still have a property manager managing the property, but you're actively involved and part of decision making for the property. So that's nice. But Matt, I make over 150K a year. I want to use my rental real estate losses. And we get this all the time. We'll have physicians or high income business owners, and they'll come to us and they'll be like, I love real estate. I want to go use all these losses on these rentals and this portfolio I'm building. And I want to use it to offset my income as a physician or my income as a business owner. Well, okay. The only way you are going to use those rental real estate losses to offset your ordinary income, if you make over 150K, is if you are a real estate professional. That's it. You have to be a real estate professional. And it's tough to be a real estate professional. I'm not a real estate professional. I have between 5 and 10 rental properties. I don't know. I got some in partnerships and everything. I've got a rental real estate portfolio that in the end has losses. I can't take those losses to offset my business income as a lawyer or directed or a Main Street Business Services, any of the companies I have that have income on my ordinary income operational side of my business. They're stuck as rental real estate losses. I can use them, I carry them forward. Sometimes I can offset against gains I have on properties, but I'm not offsetting my day job or my business. Now, who can use that income to come over? You have to be a real estate professional. If you're a real estate agent, a contractor, real estate developer, if real estate investing is your primary occupation, you can be deemed a real estate professional. Now, there's a three-part test to this. You have to work 750 hours in real estate in the year. It has to be your primary occupation, 50% or more of your time. So if you're a doctor, I'm sorry, it doesn't work. If you're a lawyer like me, it doesn't work. All right. Even if I spend the 750 hours, we have to hit all three of these. And you have to materially participate, okay, in the rental properties in order to take the loss to offset your other income. So now this is why people like Donald Trump, Grant Cardone, a lot of people who are very public about how they pay no taxes on real estate, Pace Morby, Chris Crone, they all talk about this. A lot of big real estate influencers that have large real estate portfolios talk about how they pay no taxes. Well, guys, that's because their primary occupation, their primary business is real 50 hours. It's their primary business, and they materially participate in the properties. That allows them to take those losses to offset any of their other ordinary income. Easy ones that we have a lot of our clients that can connect on this one: real estate investors, obviously it's your primary occupation; real estate agents, that's another one that can qualify. Now, another cool rule that a lot of people don't know and aren't aware of for married couples, if one spouse is a real estate professional, you both qualify. All right, and this is pretty cool. So let's say that you're a dentist and your spouse is a real estate agent, and you also have a portfolio of rental properties together. All right, well, you are a real estate professional for tax purposes because we only need one spouse to qualify with the status in order for both of you to qualify in your return. So sometimes we'll have that where we have one spouse that's more involved in the rental real estate, either as an investor or they might be actually in the real estate business themselves. And since they qualify, the day job income of the dentist, the lawyer, the doctor, the business owner that's not real estate, that income can be offset by the rental real estate losses. Okay, now, don't be bummed out that you're not a real estate professional. I still like investing in real estate personally. I still do it. I do it in my IRA. I do it in my 401k. I just like real estate overall because real estate appreciates. I can receive the cash flow and have that as income. I don't pay taxes on it in my personal name because of depreciation expense typically. Now, obviously, if I go over that, if I have a really great rental income and cash flowing property, it is going into my taxable income. And so there's so many benefits, of course, to owning rental real estate. But the main myth that I wanted to bust today is you cannot use your rental real estate losses to offset your ordinary income unless you are a real estate professional. 750 hours, that your primary occupation is real estate, and you materially participate. You have to hit those three things to get these rental real estate losses to offset your ordinary income. Now, I still love rental real estate. I still want you to have it because let's not forget the cash flow on the rental property is not taxable to you for everyone. That's why I still love it. I'm not a real estate professional. I can cash flow on the rental, have money in my pocket, be paying down the mortgage, but not have a taxable income to me because of the depreciation expense. So remember what we went through there on the depreciation expense? That's still going to help me. Worst case scenario, it carries forward to future years, or I can offset it on other properties if I have multiple properties and properties with gain. All right, so that's the item I wanted to hit here on the rental real estate topic and the tax benefits and myths. I don't know if we have any questions on point at this moment for rental real estate. All right, let's hit the questions that came in advance though. So I have, I think I'll have time to hit all these. Let's see, we'll just see. Let me see how we're doing on time. Okay. All right, this is from Joe B. Joe asks, for a child's Roth IRA, can you help me understand why W-2s and 1099s aren't required? If you pay an employee any wage or a contractor over $600, a W-2 or 1099 is required by law. Okay, so it's a good question, Joe B. What I'm saying, when I say whether it's required or not, is for our purposes at Directed IRA, I don't make you verify when we do a kid's Roth IRA. I don't make you show us the kid's W-2, just like I don't make you show me your W-2 when you put money in your IRA account. I don't make you show me your 1099 and your 1040 to show me you had earned income. When you contribute to an IRA, it's your job to know whether you had earned income or not that qualifies under the rules. Same thing for a kid's Roth IRA. Now, some companies that do kids' Roth IRAs, Fidelity, for example, makes you show a W-2 or a 1099, showing that the kid had earned income. Now, that's not required by law. That's just a process they wanted to incorporate in their procedure to make sure they knew the kid had earned income. That's just not something we want to do for one primary reason. We have a lot of small business owners that pay their kids from the business, and they're not required to issue them a W-2. There's a specific rule for family-owned businesses where children who work in the business are not required to be issued a W-2. They're also not required to be issued a 1099. It's booked as outside labor on the company return, and a W-2 and 1099 are not required in that instance. So a lot of our business owner clients have their kids involved in the business and pay them in that method, and as a result will not have a W-2 or 1099. So that's the why. And for even for me, I've paid my kids through the business and not issued them a W-2. Now, when you pay kids in the business 18 and older, typically you will 1099 them, and they'll pick it up as income on their return. But kids under age 18 that are working in a family business, there's a way, if you're doing it properly, you don't have either one. All right, AJ asked, can a spouse and I pool solo K money into a single LLC? Yes, you could. There's a couple different ways to do it. The primary way is if you have a solo K with a traditional account and your spouse has a solo K with a traditional account and you want to put them into one LLC to do investing, you can do that. We would break up the ownership in the LLC based on how much came from your solo K's traditional account versus your wife's solo K traditional account. You could have a Roth account and a traditional account in the solo K. Your wife could have a Roth account and a traditional account in the solo K. We have 4 accounts going into one LLC that's going to buy a specific asset. So you can pool multiple accounts, whether they're IRAs or solo Ks, into an LLC to go purchase a property. Now, you'll need guidance on this from a lawyer, and our law firm KQS Lawyers can help with this. It is possible to have an LLC owned by the solo K plan. And the solo K plan owns the LLC 100%, and you have a separate accounting that's your job, not ours, because I can't account for this in your accounts here, where you break up the money and the percentage of ownership in the LLC at the plan level, okay? So it is possible to do a single member LLC at the plan level, and you have individual solo K accounts invested into it. Just know that's a special circumstance. You need advanced planning advice on that. The lawyers at KQS Lawyers can help you there. Hopefully that makes sense. If that's over anyone's head, don't worry about it. If some of you are like, ooh, I'm interested in that, get a call with the attorneys at KQS Lawyers. Okay, at what equity level in the LLC do you start to split up into different LLCs? I heard one investor say they start to split it at 1 million to 2 million in equity. Okay, this is from Spencer TN USA. Okay, this is a great question. So now many of you know our trifecta, right? This is what we do. This is you down here where you're filing your 1040 and hopefully you have a trust for your estate plan. By the way, it's estate planning month in the law firm right now. So get over to KQS Lawyers. We're doing estate plans right now. It's the only time we discount it during the year is right after Memorial Day. Get it done. Go over to kqslawyers.com on the homepage. Everybody needs your estate plan done. Okay. All right. As a Spencer's question though, how many LLCs do I need? And do I need to split up based on equity? He's saying 1 million to 2 million in equity. All right. This is you own an LLC 100%. That LLC owns, let's say it owns 3 properties. Okay, now let's say something happens on property number 1 here. The tenant slips and falls. Well, that tenant in property number 1 can sue the LLC. And property number 2 and 3 are also at risk. So if I have, 300,000 of equity here, 400,000 of equity there, and 400,000 of equity here, and that tenant sues the LLC, I've got 1 million of equity at risk here. And I don't love that. Okay, so generally we don't like seeing clients have that much equity in an LLC. Our rule of thumb is about 200,000 to 250,000 of equity. Once you have around 200 to 250,000 of equity between multiple properties in the LLC, we like to use separate LLCs. So now, rather than having this scenario here, what we're going to do instead is, if this property has 300,000 of equity, okay, hang with me here. All right. Now it's going to have its own LLC, and then I'm going to have another LLC, and then I'll have another LLC. Because I had 300,000, 400,000, and 400,000 of equity, I would do separate LLCs for these properties. There's enough equity at risk that if something happens on that rental, I don't want them all in the same LLC like we showed before. Now, if that tenant slips and falls here, they can only sue this LLC. They're stuck. They can't come over here. They can't come over here to this other LLC. They're stuck at getting anything that LLC owns that own that separate rental that had that separate lawsuit and liability. So that's when we will look at using multiple LLCs. Now, I have clients that own over 100 properties in one LLC. Like, I literally have clients that own over 100 properties in one LLC, and it drives me bonkers. On the other hand, we have clients that do one LLC per property, and they don't even have 100,000 of equity in that property. And I think that's probably overkill. We want to be in the kind of the middle here. There's a cost to setting up multiple LLCs and a little bit of administrative work. So we want to make sure it's worth it. Our rule of thumb, if just from an asset protection standpoint, is it's worth it once you have 200 to 250,000 of equity. Now, there's a lot of variables there. Let's say it's a multifamily property. Let's say it's high-risk tenants. Let's say it's a short-term rental. I might just do one LLC for that property, even if that property only has 50K of equity, because I don't want to mix in my other rentals that are a little more clean in the mix with that multifamily deal or that short-term rental. It's got a lot more tenants, a lot more risk, a lot more liability. I might condense that property into one LLC itself. All right, Tristan, we have a question here.
Yeah, we have a question and a comment. I'll read the comment to you first, and then we'll give the question. Alexi said that he is going to open a dating service company to match high-income earners with potential real estate professional spouses.
Perfect. You don't want to, want to know where to go to the best place to go market that? Go to the real estate associations. The realtors associations in your state, they're like 80% women as it is, you can call it taxmatch.com.
That's great. Okay. We got another one from STG80. Can you explain 1031 for getting a foreign property? For example, an individual sells their home in the US and wants to buy a home in South America.
Okay. I don't know that 1031 works in a foreign country. From my understanding, it doesn't. So that might be the short answer. I don't know. I'm pretty sure it's just for you. The replacement property has to be in the US. I'm not 100% sure. We can fact check that. My team can look that up while we're waiting here, but so it wouldn't work. Now, 1031 exchange is a great way when you're having this rental property. And let's just go back to this example I had up here. Okay. Let's say you've owned this property. Okay. We bought it for 300K. And let's say 10 years later, okay, let's say now the property is worth 500K. And let's say that the mortgage has been paid down to, let's say you put 60,000 down. Let me just change this up a little bit. Let's say this was the down. And so this was the mortgage balance. Okay. It kind of works the same, 20% land or building, but all right. So let's just look at this property here. 300,000 purchase price initially, 60,000 down, and 240K was the mortgage balance. Now it's worth 500K. And let's say the mortgage balance over 10 years has been paid down to, I don't know, let's say it's 180, okay? So when I sell this property, I bought it for 300. I'm at least going to have a $200,000 capital gain, right? And I pay long-term capital gains because I've owned it 10 years, which would be 20% rate federal. You'll have a state income tax rate for those in a state with a state income tax. So that 20% on a $200,000 gain has to be a $40,000 tax bill. Well, if I sell that property for 500K, if I sell that property for 500K and I instead reinvest into a property 500K or more in the US, I can avoid paying the tax. The gain, that $200,000 of taxable gain doesn't hit my 1040. That $200,000 of capital gain rolls into the replacement property. So this is the 1031 exchange. I went from one property to the next, okay? Now, I can keep doing a 1031. I can do that and keep buying bigger and bigger properties, right? You can go from Ocean Avenue to St. James Place, from St. James Place to Marvin Gardens to Park Place, and rolling all that equity, getting into bigger and bigger properties. But meanwhile, each time you're buying a property, you're not having to pay more, you're having to pay tax along the way. So that's the 1031 exchange. It's a great tax strategy. A lot of our clients use it. And it's a way of tax deferral. You're not getting rid of the tax, but you're deferring it into the next property. Now, there's some timing rules on that. You got to buy the replacement within 180 days. You have to recognize the property earlier. So it's not meant to be a 1031 lesson here today. We do have prior podcasts on the 1031 exchange, specifically at the Main Street Business Podcast. But 1031 exchange, definitely got to know it for real estate investors. Now, one other thing I didn't mention, that depreciation expense you're taking every year, by the way, you have to recapture depreciation expense. This is kind of one of the devils of depreciation a lot of people don't talk about. When you sell the property, you recapture that depreciation expense that you've taken when you sell the property. And so if I've got 10 years of that, that might be $87,000 of depreciation recapture income that I have here for that property. Now, if you 1031 again, you can roll the depreciation recapture as well into the next property. So the 1031 can get rid of the gain and any depreciation recapture as well. So cool strategy. I just don't think it works for foreign properties.
You cannot buy foreign
There
properties
you can't
in a
do it
1031.
foreign. So Latin America, sorry. Maybe do New Mexico. Not Mexico. I don't know. All right. Any other live questions?
Yeah, we did actually get one, a little extension of 1031. Alexi asked, if I received income from sale of property, which I was a partial owner of, can I still reinvest the money using 1031 without paying tax?
Ooh, okay. No. Okay. Well, it depends. Okay. So here's the other thing on the 1031 exchange rules. When you sell a property, let's say Matt Sorensen sells a property. When you rebuy a property to do 1031 exchange, Matt Sorensen has to be the repurchaser of the property. Let's say I'm in an LLC, Alexi. Let's say me and you are in an LLC. I own 5%. You own 5%. There's a bunch of other investors in there owning 90%. And let's say that LLC owns a property. Okay. I own 5%. You own 5%. We got other investors owning 90%. Okay. LLC sells. Okay. The only way you're going to be able to do a 1031 is if the LLC rebought a new property, because the gain is claimed up here at the LLC level. What's going to happen is we're going to each get a K1 with our share of the profits trickling down to us individually, and it's going to hit our 1040. I can't take that K1, which is just the tax form you get when you're a partner in an LLC. I can't take that K1 and 1031 that interest. So whatever entity or individual is selling the property is the one that does the 1031. All right. Now let's say that you and I are in an LLC together. Let's do another example. Okay. Let's say I have an LLC and let's say Alexi owns 50% and let's say that Matt owns 50%. Okay. It owns a property we want to sell. Now, let's say that we decide, hey, let's just buy a new property. Let's buy a bigger property together. Let's keep the same LLC and we'll go buy a new property. Cool. We could do that. We do a 1031 at the LLC level. The LLC buys a new property. No gain recognized at the LLC level. No K1 gain passing down to Alexi or Matt. We got a new property. Cool. Easy enough. Now, however, let's say instead of that we sell the property, but let's say that Alexi's like, hey, I want to 1031 this. And I'm like, no, I want to get all my money back. I want my money back. I want the cash back. I'm doing my own thing, Alexi. It's been great being partners with you. You want to do a 1031? Go out on your own. Now, if we own this in an LLC together, well, how do we do that? Well, what you do is you deed the property out of the LLC. We're going to do a 50-50 deed, what's called tenants in common, a TIC, tenants in common. Rather than each of us owning the LLC 50/50 and the LLC owning the property, which we love for asset protection, to get the 1031 exchange rule, and this is common, we would deed the property out of the LLC into a tenant in common arrangement where you personally own it, Alexi, 50%. I will own it 50%. Now, when the property sells, you can take your 50% because you own real estate directly now in your name, and you can go repurchase a new property. I can take my 50% and I can cash out. Okay. So there's a way sometimes to do it by deeding the property out of the LLC into the individual owner's names. If one partner, for example, wants to 1031 and the other one wants to cash out and move on and do their own thing. So we do that strategy sometimes to get the 1031 for one partner when the other one's going to not stay. Now, if you're a 5% partner in a deal, you're not going to have any influence to do that. You're just going to get your K1. If the partnership LLC, the fund, whatever it may be, was going to do a 1031, you get the benefit. If they're not, there's nothing you can do. So hope that makes sense on the 1031. Good question, though.
All right, we got a question from Mac. Where or how does the holding company come into the picture on the single LLC with too much equity?
Okay, so holding company is not for everyone. Let me just say that. I know a lot of people use the holding company strategy, so let me just re-diagram this again. So this is our trifecta. This is Mark and I, we coined this in the law firm years ago. This is how we divide up all of our clients' lives. So we usually have our operating business. So we have operations and we have assets. For you real estate investors or anyone with rental properties, the rentals are going over here on the asset side. This operations is usually like your S Corp or even your LLCs that are doing operating businesses. You're selling goods or services, okay? We use S Corps because we can save taxes on those types of businesses and that income. And also I like to keep it separate from your assets. I don't want liabilities in your operating business affecting your rental property assets over here, okay? All right, now let's say you own 2 rental properties, okay? Let's say each of them have 50K of equity, okay? There's 100,000 of equity total, so you just have one LLC, totally fine. Now, you might want to do a holding company like this. Generally, we use Wyoming if we're going to do this and do a holding company. Now, again, I don't recommend this for everyone. Generally, for clients that have $1 million in net worth or higher, we would consider this. If you don't, I don't know that I would necessarily consider this for everyone. Now, you might want to do it early and grow into it. I get it. I see people do that. But the holding company is right here. This then becomes essentially the property LLC. The purpose of this LLC here that owns the property is if there's a lawsuit, they're forced to sue the LLC. They're stuck here. They can't come down to the holding entity. They can't get to any other assets that the holding entity owns. Well, why do I need the holding entity? I mean, they're stopped here. What do I need this for? Well, we use this for what's called charging order protection. What this LLC does is, let's say I had something happening over here in my business. I had a lawsuit, or let's say I had a lawsuit and a judgment against me personally. Okay. I defaulted on a loan that I personally guaranteed. I had a personal liability somewhere. I had a car accident, something insurance didn't cover, credit card that I didn't pay, whatever. Okay. You have a judgment against you personally. So you owe money personally. Well, one of the things a creditor can do is get into any assets you personally own. Those are going to be at risk. Now, your retirement account's asset protected from a creditor. Generally, there's asset protection benefits for your home up to a certain amount of equity. It depends on your state. But if you have a lot of rental real estate assets, that's immediately where they're going to go. And what they can generally do is go straight into any LLC that owns a property. If you have a holding company here in Wyoming, though, it has what's called charging order protection. We sometimes call it a COPE for charging order protection entity, COPE. Now what happens is when they have a judgment, they have to go up the line here and they can't get into the LLC to get the assets. Instead, they get what's called a charging order protection entity. Now, if this is an Arizona LLC, like where I'm at, or, I have Indiana LLC for rentals there, they can blow right through the LLC. And in most states, they can go right into the LLC and get any assets. But Wyoming has this charging order protection entity. So that's why some of our rental real estate clients use holding entities, is for that purpose. There's another reason people will use holding companies. Here's another reason. Let me just diagram that out. Let's say you have a lot of LLCs and okay, they all own multiple, these are properties, of course. And you might have one kind of main holding company LLC that is a partnership. Okay, this you file a 1065 return, and this is maybe you and a spouse together and you file a partnership return. We do have lots of clients who like to do that, less audit risk with a partnership return. And then you don't have a ton of properties on your Schedule E on your personal return. So you may do a holding company like this kind of for some tax minimization, simplification, all the rentals go on a 1065 partnership return. And then each of these are just single member LLCs, no separate return. Now, if you don't have this here in the middle, right, these LLCs are just going to your 1040. There's no tax return for a single member LLC, but it's hitting your 1040 and each property is on Schedule E on your personal return. A little more audit risk. This is not causing more or less tax. It's kind of more of a simplification audit risk issue, why some larger investors might use the holding company strategy for some minimization. Now, the typical real estate investor with a day job or a small business that owns less than 5 properties, we're probably not doing a holding company. We're not. If this is a big piece of your wealth development plan is owning 10 plus properties, or you at least have $1 million in assets of net worth, let's talk about it. We might talk about the asset protection benefit of the holding company for the charging order protection entity that would be Wyoming. We might talk about it from a tax reduction or a tax simplification and less audit risk strategy for those of you with lots of LLCs and properties. But it only works for those of you that are married, where you do a partnership return. Okay. All right. Let's roll to some of the other questions we have in the hopper from Team Wealth. This was from Bill. Bill asked, I'm looking forward to the crypto multi-exchange Roth IRA LLC checkbook and want to know if I have to file taxes on my crypto transactions. Also, if I have to pay for an app that manages assets. Now, we answered this one actually on the last Team Wealth Live, or someone that had a very similar question. So, all right, when you're buying crypto with an IRA, we have what's called a crypto IRA at Directed. It comes with a Gemini exchange account, and you can buy and sell crypto out of that. That is all consolidated for tax purposes. Gemini knows that your IRA owns it at Directed Trust Company. There's no tax reporting going to the IRS on this. There's nothing hitting your social or anything like that. Now, if you're like, I don't like that, Matt, I want to go my own way and do my own thing. I don't want to use Gemini. I want to go off exchange, or I want to use different exchanges. Cool. It gives you a lot of benefits, but it has some downsides. You're going to have to manage the tax reporting. I don't know XYZ exchange you use understands what the hell an IRA LLC is, and that actually your Roth IRA owns this at the end of the day, and they used your social security number to identify you for KYC and AML and banking law purposes. Did they use your social also for the tax reporting? And are you going to get 1099 or 1098, excuse me, for the trades? What is it, 1096? I don't know. Are you going to get all the trades on your personal social? I don't know. And that's where this is kind of up to you when you do an IRA LLC. You're going to really have to make sure you manage that. Honestly, that's one of the main reasons why I use the Gemini crypto Roth just for my own crypto in my IRA. Would I rather be off exchange? Yes. But there's this tax compliance angle to it that I'm trying to be okay with. Now, that doesn't mean don't do it. We have lots of clients that do it. They have to be super careful on this. All right. So also, if I pay for an app that manages assets with my trading efforts, do those funds have to come from an LLC account, or can I pay those out of pocket? Okay, yes. If that app is for the IRA LLC specifically, then you would need to, the IRA LLC would need to pay for that app or that service that's being used to manage the trades. All right, this is from Ask Matt. Remember, you can get to Ask Matt. Go to mattsorensen.com, Ask Matt, click on that button. You can ask your questions, tax, legal, wealth building. I'm going to answer them here for you every week. This is from Shauna. Shauna asks, I'm 49 and recently did a hardship withdrawal from my current employer for college tuition debt that was owed. Can I redeposit the money I withdrew back into the same 401k plan with my current employer if I changed my mind? Okay. No, unless this was in 60 days. Okay. If this is within 60 days and you're like, dang it, why did I do that? You can redeposit it back in. This is for any withdrawal or distribution you do from an IRA or 401k. You can do what's called a 60-day rollover to get the money back. Now, if this was like last year when you did this, for example, and you took the distribution, there's no way to get it back in post 60 days. Now, if you took a loan out, there's other where you can get a loan from your own 401k to yourself. You probably could have bought yourself time, but sorry, Shauna, not a good way to get that money back in. Now, when COVID had hit, there was something called the CARES Act that got passed, and there was a lot of relief in 2021 and 2022 to take money out of your 401k, and they were giving more people time to put money back in. But all those rules have passed by now. So sitting now in 2024, I don't see a way to get that money back in. Again, unless you're within that 60-day window. All right. Another question from the Ask Matt was from Jeff. Jeff asked, we currently own a rental property in our IRA LLC. We're a good 10 years from retirement, but starting to think about the possibility of converting this property to personal use someday for our retirement years. I think the best case scenario with the rest of our investments, this property would likely still account for at least 10% of our overall retirement portfolio. Are there any ways to do this, and wouldn't essentially be a lump sum distribution of the entire value? Is there any way to avoid that, or any alternatives to offset that impact? Okay, good question. All right, let me just diagram this out. Okay, so Jeff, IRA, and I presume this is a traditional IRA, owns an LLC that owns a rental property. Now, right now, they're renting it out. They're getting rental income on it. And Jeff said, hey, we're 10 years away from retirement. Let's say I'm 50. When I hit 60, I want to get this property out and we want to use it. I want to live in it, or maybe it's a second home or whatever. And we want to have personal use of it. We're going to still keep collecting the rent. It's going to go up in value. But in 10 years, I want to pull it out. Okay, you can do this. Now, as Jeff asked, and he knows this, you're going to have to take a distribution. Now, this will be once they're 59 and a half or older, so there's no 10% early withdrawal penalty. But once you hit 59 and a half, what Jeff can do is he can take a distribution. And what I would do here, we would take a distribution of the LLC interest that owns the property. Now, at the time here, when you take a distribution, Jeff, we have to look at, well, what is the value of the LLC? Your IRA owns an LLC 100%. What's the value of the LLC? Well, let's say in 10 years, the property's worth $500K. And let's say you have $20K in the bank account, the checking account for the LLC. All right, that's $520,000. And that's going to be a distribution. Now we're going to distribute the LLC interest from your IRA to you personally. Now, if you might just get rid of the LLC. You could keep it. It doesn't hurt. By the way, even if you move into this and convert it to your home, single member LLC, you could still get sell of home exemption. But in your scenario, Jeff, your IRA doesn't own the property. It owns the LLC. Now you might say, well, I don't want to take that $20K out. Okay, cool. Send that back to your IRA. Just let that $20K sit in cash here. And then the only thing the LLC owns, the checking account's been cleared out, is the property. And you're going to have to go get an appraisal, by the way, of what the property's worth at the time of distribution. Okay, you don't get to just like guess this or use a property tax assessor record or something. You actually need to go get an appraisal of what the property's worth. So, and in that case, you could then, your distribution would be $500K. So now that does go into your taxable income. Now, Jeff's question, sorry, I was getting the setup there and how this works. Jeff's question was, is there any way to minimize the lump sum tax of the entire value? There's one way. Now you want to get it out all in 1 year. There's one way to do this, and it's really doing two distributions in December of 1 year and January of the next. Because you got to go get an appraisal, and the appraisals, maybe 60, 90 days max, we can use them to assess value. Otherwise, you're going to have to go get a new appraisal. A nice way to do this is you could at least break up that $500K between 2 years. So in December, and let's say this is in 2034, we're going to distribute 50% of the LLC to you personally. That's $250K. Jan 1 or maybe, January 2nd, whenever we can get to that. We're actually closed January 1, it's New Year's Day. But you know what I mean? We do the second. So this is 2035. We do the second 250K. So within a matter of a week or 30 days, you can have both pieces distributed, but over 2 different tax years. That way it'll keep you at least in a lower tax bracket, or at least delay half of that tax burden out into the next year's return. So that's a little way to delay it. You could do it in multiple chunks over the years, but your LLC starts getting super complicated, and you could kind of chunk it out over 3 or 4 or more years too, but you still can't use it until the property is 100% distributed. So that's why I kind of like to look at year end. Is I know I can get it out within a 1 week, 30-day window, 1 appraisal, break it up over 2 tax years. Kind of like that scenario. All right, what do we got in terms of live questions? Okay. Let me come back to the 1031 exchange rules that Alexi had, because the 1031 stuff is super relevant to any real estate investor in the conversation on the tax benefits of investing into rental real estate. Now, if you are in real estate investing for the long haul, and we think real estate investing is one of the best accelerators to building wealth. When I'm talking about how does someone build wealth, the 2 primary drivers of wealth that can be accelerated is business ownership and real estate investing. Those aren't the only ways to build wealth. There's so many different ways to build wealth. We have so many different wealth profiles we've developed that we're going to be sharing and showing you on different ways to build wealth. But the 2 primary accelerators that can drive wealth the fastest is real estate ownership, primarily on the investment side, and business ownership. Now, real estate comes with a lot of tax benefits. We already talked about the tax benefits of the cash flow. Even if money's in your pocket in your bank account at the end of the year, you actually don't pay taxes on it because of that depreciation expense. But for those of you building a portfolio over time, we're going to buy properties at great values and sell them when they appreciate, right? And maybe you want to trade up the assets. Maybe you want to get into better performing properties and larger properties. And so as you're doing that, the 1031 exchange is a great strategy. And that is one, as we mentioned, you can trade real estate for real estate. Now, this has to be in the US. That was from Alexi's question. This also has to be the seller of the real estate has to be the new buyer of the real estate. So sometimes you might have to do some title change. We went through the examples there. Do you have an LLC or not? Is there a partner in the mix? Maybe you need to do tenant in common situation. But on the 1031, I can sell that property. And as long as I buy a property for equal or greater value from what I sold the property at, I can defer the gain. I pay 0 tax on the sale of the property because I put that gain into what they call the replacement property. That gain is tax deferred. It didn't go away. It's just sitting in the next property. But from a tax strategy standpoint, one of the cool things, a lot of things our real estate investor clients have done, is they have multiple millions of dollars in a rental real estate portfolio. They've 1031 and keep accumulating and buying more and more assets over time. They've never claimed a gain they've paid tax on because they continue to build the portfolio. They're not taking the chips off the table, so to speak. When they make money on a property, they're rolling it in to buy more property or to buy a bigger property. And because of that, they're building massive wealth. They're accumulating assets. That's the whole purpose of wealth building. It's not to sell properties and to take the money. It's to continue to buy more assets. If I cash out on a property, what am I going to do with the cash? Am I otherwise investing it? Am I putting it into some other investment that's non-real estate? Am I using it to start a business? What am I going to do with that money? From a wealth building standpoint, we just want you to buy more assets. I mean, that's the key. Accumulate assets that can produce income and appreciate over time. So 1031 exchanges play perfectly into that, right? Buy more assets, up the game, get into more properties. You can even use more leverage in that instance because now you have more equity that can buy bigger properties. You can attach more leverage to. So as I'm doing that wealth building, though, I'm not paying taxes. I'm building the more and more assets. But a lot of people are like, well, Matt, how do I eventually live off of that? Well, hopefully those properties are going to have great rental cash flow. You're building a bigger portfolio, greater income as you're creating more assets, but you can also strip out the equity. This is one of the things a lot of people beat up Donald Trump when his tax returns got exposed. It's like, wait a second, how does Donald Trump have 0 taxable income, but he's purportedly a billionaire on paper? Well, that's because he has a huge real estate portfolio. He's a real estate professional, as we talked about earlier today. So all of that income he has from TV shows and other things he does, his primary occupation, before president in politics, was a real estate professional. So he was using all of his rental real estate losses from his properties to offset his other income. But what did he also do? He also enjoyed his wealth in these assets by stripping out equity. When you take out a loan against property, that's not taxable income, that's debt. So if I've got a $10 million real estate portfolio and I take $2 million of loans against that I go spend on whatever the heck I want, that's not taxable income to me. I got the benefit and value and enjoyment of $2 million to spend on whatever the heck I wanted, but it's not taxable income to me because it's debt. Now I still got to pay the bank back. There's a cost to that. Of course, it's not free money, but that's how people who are building wealth can then utilize that asset over time as they built it without having to sell the property and pay the taxable gain. They can strip out the equity and use debt. All right. Any other pending questions right now? All right. Okay. Well, thank you everyone for joining us for Team Wealth Live. If you're still on, please make sure you subscribe to the channel. Be subscribed over the YouTube channel. Join us over on the private Facebook group, Team Wealth. We're going to have more going on in that in the future. We want to make sure everybody is over there because it'll be a future place where we're going to communicate and do more training over there as well. And then we'll be back, of course, next week with another amazing episode of Team Wealth Live. We'll see you then.